right. Um, I'd like to take this opportunity and discuss financial planning model. All right. So this corresponds to chapter 7 in the lecture notes. And this is right after the equity valuation discussion because the equity valuation discussion provides what we need to implement this financial planning model. Okay. All right. So financial planning model. All right. So just a little overview here. All right, so this is actually a very, challenging, thing to do in Excel. Okay, so the financial planning model is also known as the pro forma models because we're actually going to forecast the firm's, financial statements in the future. Okay, so we're talking about, forecasting well, actually, I should say, there are many steps for us to follow in order for us to actually, implement, build and solve a financial planning model. Okay, so the first step is, build upon existing financial statements. Okay, so we know from accounting that there are three major financial statements. The first one is the income statement, okay, or and also the balance sheet. All right, so these are the two major financial statements we are going to use. Some of you also, think of the, statement cash, cash flow statement or statement of cash flows. All right, so we are finance people. We're going to build our own cash flow statement and we're going to use that to value the firm. Okay, so income statement, balance sheet. All right, so balance sheet is like, is a static, is like a picture, like a snapshot. Income statement, it is like a video. All right, so it actually records what happens over the course of the year. All right, so this actually is going back to your account, finance 201 clause. Okay, so this is our first step. We're going to build upon existing financial statements and we focus on two of them. All right, and then we're going to make, two sets of assumptions. Okay, so really, in order for us to actually, project the financial statements in the future, we would have to rely on a set of assumptions. All right, so we're actually going to make two sets of assumptions. Remember, I'm talking about two sets. So really, this is a lot of assumptions. And the first set is the value driver set. And the second set is the financial policy set. Okay, don't worry, we're going to actually talk about them, in great details in a second because we need to build this assumptions into our model. All right. So once we have the assumptions made, we can now actually forecast the financial statements in the near future. Okay. So we have the starting point of the financial statements, and then we have the assumptions. So combining these two would allow us to actually, take a peek into the future. All right. So, where the firm has been at this point, where the firm is actually heading in the future. All right. So we're going to actually forecast the financial statements in the near future. All right. So after that, we're going to actually, calculate the free cash flows to the firm. Okay, and perform the free cash flows to the firm valuation approach. All right, so this actually is where we're going to resort to the equity valuation discussion. All right, so we have the free cash flow valuation approach, and once we are able to calculate the free cash flows, we can actually make two more assumptions, and we can actually perform the free cash flow valuation. All right, so the last step is sensitivity analysis. Okay. All right. So we just want to look at how sensitive. All right. Sensitivity. All right. We want to look at how sensitive our evaluation number is to maybe a few key inputs. All right. So these are the roadmaps, for what we're going to do. All right. As I said, this is a fairly complicated, model to build and solve. And these model, the financial planning model, actually has a lot of uses. For example, you can actually use them to, forecast the future financing needs of the company. All right. Some of you might be thinking about setting up a startup companies. Okay, so you can actually, start to think about how to forecast the future financing needs of your company. Okay, so that's one use. And you can also use the financial statement to actually, create a business plan. And more importantly, for our, purpose, we're going to use this to value a firm. All right, so, and, we're going to actually build and solve this model, in Excel. So, getting ready in Excel. All right, so let me actually show you what we need to do in order for us to actually be able to solve this model in Excel. All right, so we will need to use, circular reference, and we're going to use, circular reference and iterative calculations, okay, to solve the financial planning model. All right, so this actually is something Excel is able to do for us. In other words, you can actually let Excel solve the model for you by enabling something called the circular references and iterative calculation. All right, so need to enable iterative calculation. All right, so let me show you how we can actually do that. All right, so earlier I showed you how to actually activate the solver plugin and how to, for instance, activate the data analysis tool pack to run a regression, to do a histogram, and so on and so forth. So here we're actually going to activate or enable iterative calculation. All right, and if you do not enable iterative calculation, then Excel is going to actually report like an error message saying you're using circular cell references and I don't know how to solve this model. Okay, so that is the consequence of not enabling this iterative calculation. Right. So let me go to Excel file, and we'll go to options, and this brings up the Excel option dialog, and go to formula. All right, if I go to general, if I want to go to solver add-in or data analysis tool pack, I would go to add-ins. Okay, if you click on add-ins, you can see all this active application add-ins. But here I'm going to go to formula, and there's something called workbook calculation. All right, so you need to set that equal to automatic, and you also need to check this box here called enable iterative calculation. All right, so once you have this enabled, then Excel is not going to report any errors of circular cell references, and Excel can actually solve this model for us. All right, and we don't have to change the maximum iterations or the minimum or the maximum change. In most of the cases, it's very straightforward for Excel to solve. Okay, so click OK, and now we can actually, now it's enabled. So let me just recap what I did. All right, file, options, Excel, options. We have the Excel options, and we have the formula, and check the box for enable iterative calculation. Okay, so in case you forget how to do that, I'm having this explanation here. Okay, all right, so let's actually look at the existing financial statements. All right, so here we're going to actually look at a hypothetical company called Whimsical, Toenails. So basically, this is a company that actually, makes people, makes people's, toenails, beautiful. All right, it's a toenail painting store. It's actually a chain store. All right, and we actually have the, income statement and a balance sheet for this whimsical toenails, and we have the numbers there, on lecture notes. So please, make sure you have your lecture notes side by side. All right. So we have the first one is the income statement. That's actually, is as of December the 31st of 2004. All right. So we're talking about these accounting terms here. We have sales, cost of goods sold, depreciation, interest payment on debt. So the company actually has debt, so they're actually paying interest. And then, you also have interest earned on cash. So the company actually has, cash. So you may wonder, why don't you just use, the cash to pay off your debt? All right. So this is a very good question for you to discuss in Finance 380. All right. One of the reasons is that, if you actually have tax, you can actually enjoy the tax shield, effect. Okay, the tax benefit of having debt. All right, basically the interest payment from, debt is actually tax deductible. All right, and then you have the profits before tax, and you're paying 40% tax rate. So you have the profits after tax, and then you start to, feed your shareholders. Okay, you pay out the dividends, and then you retain the rest as retained earnings. All right, so last time we also discussed the notion of retention ratio and a dividend payout ratio. Okay, so that's the income statement, and then we also have the balance sheet. All right, the balance sheet is a tier account. So on the left hand side, you have the total assets. On the right hand side, you have the liabilities plus shareholders' equity. All right, so you look at the total assets. That's actually 10 million. And that's the same as the total liability plus equity. So the balance sheet is balanced, right? And then if you take a deeper look into, the two sides, you have cash, all right? And then you have, current assets, okay? Some of you immediately realize, why do you actually have cash, separate from current assets, okay? So if you look at, your accounting, clause, in that clause, cash, it is part of current assets. Okay, so here we're finance people, so we treat cash slightly differently. All right, so we're actually separating cash from current assets because we want to actually focus on the operational aspects of current assets. Okay, so things like inventories, things like accounts, receivable. These are current assets. But for cash, actually is separate from current assets because cash, in our mind, is a financial asset. Okay, so that is why we have cash, outside of current assets. Okay, and then you have the fixed assets here. So the fixed assets, at cost, as well as the total accumulated depreciation, right? So the company has been, has arrived at this particular moment, and the fixed assets, they have a total depreciation over time. All right, and then you have the net fixed assets, and then you have the total assets. Okay, which is nothing but your net fixed assets plus the current assets plus cash. Okay, that makes $10 million. All right, and if you look at the current liabilities, where you have 800,000, and then you have debt, and then you have shareholders' equity, and they also make up $10 million. Okay, so we're going to actually model these financial statements into Excel, and then we're going to actually make assumptions and forecast the financial statements, and then finish the valuation exercise. Okay, so this is my overview here, and I want to actually start a new tab. All right, and this way it's easier for me to actually keep things on track. Okay, so you can follow me if you want, the objective is to build and solve the financial planning model. Okay, so we're trying to build and solve a financial planning model here. And as I said, we want to actually build upon existing financial statements, and then we're going to make two sets of assumptions. So I'm going to actually flip the ordering of these two things. I'm going to start talking about the value drivers assumption. Okay, value drivers, value driver assumptions. All right, so this is a set of assumptions. So we have a lot of them. Okay, and then somewhere here we are going to have the financial policy assumption. Okay, so these are two sets of the assumptions we're going to make. And apparently the quality of your financial planning model depends critically on the validity of these assumptions. Right? People say, garbage in, garbage out. So if you make very bad assumptions, your financial planning model is going to spit out a very bad valuation number. All right, so I'm going to look at, first of all, sales growth. Okay, so this is really driving the firm value. All right, the company is valuable because the company can actually produce goods and services, and they can actually sell them to the customers. All right, so the sales growth is the value driver. Right, so let's just say the company is it's able to maintain a 10% sales growth. Okay, and then we're going to look at current assets assumption. All right, so a current asset assumption, we just assume it's going to be 15%. Well, 15% of what? 15% of sales. Okay, so you may ask me, where do you make this assumption? Where does this assumption come from? All right, maybe I'll have a little justification in a second. Okay, and then we're going to have current liabilities. All right, so current liabilities, that's going to be another 8% of sales. Okay, so 8% of sales, that's the current liability here. And then we're going to look at net fixed assets. All right, so this actually is the total assets minus the total depreciation. All right, so the net fixed asset that we're going to assume is 77% of sales. You see that so far everything is actually tying back to the sales. That's why we say the sales are the value drivers for the company. All right, and then you have the depreciation. Okay, I should say this is the annual depreciation. All right, because as I said, we have income statement and a balance sheet, and both of the financial statements actually have depreciation. So in the income statement, we're talking about annual depreciation. In the balance sheet, we're talking about total depreciation. Okay, so don't confuse yourself. So here, the assumption we're making is about annual depreciation. And we're going to say this is actually 10%. Well, 10% of what? 10%, not 10% of sales this time, 10% of the average, fixed assets at cost. All right, so whatever fixed assets at cost is for this year and also for next year, we're just going to take the average of the fixed assets at cost and we multiply that by 10%. We get the annual depreciation for this year. All right, and then we have the cost of goods sold. Okay, so we just assume that's going to be 50% of sales. Okay, so 50% of sales here again. All right, and then we have the interest rate on debt. Okay, so as I said, the company actually has debt. So the company needs to pay interest on the debt, and that's 10%. Okay, 10% of the average debt balance. All right. Okay. So we also have cash. So the company is going to earn cash. So let's look at interest rate on cash, and let's just say the company is actually going to earn 8% interest on cash. And this again is on 8% of the average cash balance. All right, so I'm talking about the average. So that means we're going to look at the cash for this year, look at the cash for next year, and then we take the average of the cash, and then we multiply that by 8%. We get the interest payment over the course of this period. Okay, and then we have tax rate. All right, tax rate is actually 40%. We know this is probably a little high. All right, and then we have the dividend payout ratio. All right, so this is the 40%. Well, 40% of what? 40% of after tax profits. Okay, so that is the value driver assumption. Let me make them in bold. All right, and then let me just discuss the financial policy assumption here for a second. All right, so here we're going to talk about how the firm is going to deal with the debt, the equity, and so on and so forth. All right, so let's just make some simplifying assumptions so that we can actually focus on the methodology part of this model. All right, so the firm right now has debt, so we're just going to say the firm will actually repay $800,000 debt, all right, per year, per year for the next 4 years. Okay, so the firm is actually going to retire $800,000 debt per year for the next 4 years. So that's a total of $3.2 million, and that will pay off the existing debt. And after that, firm intends to stay debt free. Okay, so after that, the firm does not want to have any debt. All right, so is this optimal? Is this the best decision to make? Well, we're not touching upon that part. All right, we're focusing on this model. All right, and for stock, what are we going to say? All right, we're going to assume the firm is going to have no new share issuance. Okay, the firm is not going to have any SEOs. All right, and the firm is not going to buy back any shares. Okay, so no share buybacks or no repurchases. All right, so in your finance 380 clause, he also discussed the share repurchases as a way of paying back your shareholders. All right, you can pay them dividends, but dividends are subject to double taxation. All right, you can actually buy back their shares at a premium, and that's another way for you to pay your shareholders, and you buy them back at a premium price. All right, so your shareholders actually realize this capital gains. All right, and here I will also want to actually emphasize one more thing. Cash is the plot. Okay, so what is the plot? Oh, we'll discuss that in a second. All right, so for now, let's just hang on to this financial policy assumption here for a second. All right, so these are the two sets of assumptions, and now I'm going to actually look at the existing financial statement of this hypothetical company. All right, so I'm going to look at a year here, and 2004. That's where we start off. All right, and I want to forecast. Oops, Excel is actually trying to fool me here. All right, so if I put down 2004, Excel is insisting on formatting this as a percentage. So let me just get a number and let me call the decimal. All right, so that's year 2004, and this is year 2005, and we're going to forecast the financial statements for the following 5 years. So you may ask me, what about the year 2010? Well, we will get to that later. All right. So these are the financial, these are the calendar timeline, and I'm going to look at the income statement here. All right, and we're going to I'm going to put this in bold just to emphasize. Well, these are the calendar, the timeline, and the income statements. Okay, so that is easier for people to see. All right, so let's look at the sales. So as of 2004. The company had sales of 10 million. All right, so that's 10 million. All right, be careful with the zeros. All right, and then if you look at the income statement in the lecture note, they have the cost of goods sold. All right, so that's actually 5 million. All right, so 5 million, and therefore, can you justify this assumption that the cost of goods sold is actually 50% of sales? Well, 5 million divided by 10 million, that's 50%. Maybe this is where this 50% number is coming from, okay? So we're actually trying to make some assumptions based on the existing financial statement, and we think maybe the firm, certain, percentages will actually carry forward. All right, and then we have the annual depreciation. Okay, the annual depreciation in this case is going to be, 1 million. All right. Okay, be very careful with the zeros. All right, and then we have the interest payment on debt. All right, so the firm is actually paying $320,000 interest on debt. Okay, these are the interest payment, and then the firm actually earns interest earned on cash. The firm also has cash. The firm is actually earning interest, and that's actually 64,000. Okay, these are the numbers coming from the income statement in the lecture notes. All right, so if you want to actually look at the 320,000, and the firm actually has debt of 3.2 million, so if you divide these numbers, you actually get 10%. Okay, and the firm actually earned $64,000 interest on cash. The firm actually has cash of 800,000. So if you divide this 64,000 by 800,000, you get 8% as well. So maybe these are where these two numbers come from. Okay, so everything actually has has an origin. All right, and then we're going to look at profit before tax. Okay, so let's actually look at what's the profit before tax. And so the firm actually made this much sales, and the firm is actually incurring this cost of goods sold. The firm is actually knocking off $1 million depreciation. The firm is actually paying debt interest, and the firm is actually earning interest on cash. So that's going to be the $3.744 million profit before tax. Okay, and now you can actually pay taxes, 40%. So I'm just going to do these 3.74 million times the tax rate, which is the 40% here. So I'm going to lock down this, for whatever reason. All right, maybe I want to copy across. Okay, so the tax you're paying is actually $1.49 million. And so now you can actually calculate what's the profit after tax. Okay, so the profit after tax is the profit before tax minus tax. All right, so that's actually $2.24 million. And now you're going to pay dividends. Okay, so out of this $2.24 million, you're going to pay 40% out to your existing shareholders. Okay, so that's actually $898,560. Right, and the remainder is your retained earnings. Okay, so that's just the difference between your profits before tax minus the dividends you paid out. Okay, so that's actually $1.34 million. So this actually, just modeled the financial statements, we have observed from this company as of 2004. All right, so the next thing is we have to worry about the balance sheet now. Okay, and this is a major kind of financial statement. So let me just put them in bold as well. And the first item here is cash. So the firm actually has $800,000 cash. All right, and I said earlier that cash is going to be the plot. So let me explain that in a second. Okay, right now we're just copying down this number from the most recent balance sheet we observed. All right, and then the firm has current assets. Okay, and this actually is $1.5 million. Okay, be careful with the zeros. And current asset is 1.5 million. The sales is actually 10 million. So yes, you can actually justify the 15% assumption here. Okay, and then we also have fixed assets. All right, these are long-term assets. Okay, and we actually have to make a difference between a few things here. First of all, fixed assets at cost. All right, so this actually is $10.7 million. Okay, and then you're going to look at the total depreciation. All right. So over the course of all these years, the firm actually has depreciated $3 million, in total. All right. And now we're going to look at the net fixed assets. Oops. All right. So that's just going to be the difference between the fixed assets at cost minus the total depreciation. All right, so that is actually $7.7 million, and maybe this can actually explain why earlier we assumed 77% of the sales being the net fixed assets. Okay, all right, so that is the asset side, and we're going to actually collect them. Okay, so total assets. So that's going to be the summation of cash and current assets and net fixed assets. Okay, so that's 10 million. All right, so if you look at the original balance sheet, you actually have the total liability and shareholders' equity on the right side. But here, I already have those years for the for the future. So I would actually stack them. Right, so I would actually consider the total liability and shareholders' equity, below. All right, not on the right. Okay, so let's look at current liabilities. All right, and this actually is 800,000. All right, so this can explain why you're saying current liability is actually 8% of sales, because your current liability is 800,000, your sales is actually 10 million. All right, and then we have debt. All right, so the debt is actually 3.2 million. All right, and then you have stock. All right, stock is actually having 4.5 million. All right. And then you have, what else do you have? We have the total accumulated retained earnings. All right, so I'll just say accumulated RE. RE stands for retained earnings. That's 1.5 million. All right, so now I can actually collect them. So that's going to be the total liability plus shareholders' equity. So that's going to be the summation of these items here. All right, and yes, they add up 10 million. So the balance sheet, they are, it's balanced. All right, so I'm going to put this in bold here. I'm going to put this in bold here as well. All right, so we have just, looked at the most recent financial statement. And if you go back to the previous, tab, you see that, we are actually here in these two steps. Okay. So we actually observed the most recent financial statements, and we made the two sets of assumptions. So now our next job is we're going to forecast the financial statements in the near future, knowing that we have already enabled Excel iterative calculation. Okay. All right. So let me go back to our worksheet. And now we're going to look at, these, next 5 years, and we're going to forecast the financial statements for the next 5 years. All right, so watch me closely, And this is where we're going to actually make use of the assumptions we made. And this is where I'm going to actually explain the notion of cash being the plot. All right. So let's actually look at the sales here. So in 2005, we know the sales is going to grow by 10%. So let me take 2004 sales and let me multiply that by 1 plus the sales gross. And I want to be able to copy across, so let me lock down F4. Excuse me, lock down B4. So what I did was I actually used the PC, so I pressed F4. All right, you can manually type down $B, $4, if that is easier. All right, so that's the sales for 2005. And I'm going to finish everything for 2005. And I want to finish everything in a robust manner so that I can copy across. Okay? All right, so let's continue to the next item here. Cost of goods sold. This is saying, based on the assumption, it's 50% of sales. So let me take sales for 2005. Let me multiply that by 50%. All right, so cost of goods sold, that's 50%. And again, I want to lock down this B9, all right? So that's the, cost of goods sold. And let's look at depreciation, all right? So depreciation is actually 10% of the average fixed assets at cost, all right? So what I will do is I'm going to take the average of the fixed assets at cost between year 2004 and 2005. So let me scroll down here. And let's move on to the balance sheet. And I have a number here for fixed asset at cost for 2004, but I don't have a number yet for the fixed assets at cost for 2005. So what should I do? All right, so listen up. Okay, this is where some people might be confused. All right, so here remember we're going to let Excel solve this model for us. So what I'm going to do here is very simple. I'm going to focus on having the right formula for all the Excel spreadsheet, for all the cells, okay? So just make sure the formula is right, and then, when you press, some magic button, Excel is going to solve the model. Excel is going to actually do a few iterative calculations, and then, Excel is going to actually, spit out the correct answer, all right? So I'm going to look at the fixed asset cost for 2004. I'm going to add the next, the fixed asset cost for 2005. Even though there's nothing there, don't worry. I'm going to divide this by 2. So this is the average fixed asset at cost. And I'm going to multiply this by the 10% depreciation rate. All right. So let me lock down the 10% here as well. So that is the depreciation formula for 2005. Of course, the number is not right because there's no fixed asset cost for 2005. So expect this number to change after the model is solved. Okay, so you can actually take a note and see whether this number is indeed changing after we solve the model. All right, and then let's look at interest payment on debt. So we know that this actually is 10% of the average debt balance. So I'm going to look at the debt for 2004, and I'm going to look at the debt for 2005. I don't have a number there yet, but that's okay. As we're saying, we just focus on the right formula, right? So that's the debt balance, and I'm going to multiply this by the interest rate on debt, which is 10%, and I'm going to lock down the 10%, okay? All right, so imagine this number will change as well as you actually fill in the debt for 2005. And then we have cash, all right, interest earned on cash. So that's going to be the cash balance. So I'm going to have the cash for 2004 and the cash for 2005 and divide that by 2. So that's the average cash balance. And then I would actually multiply this by the interest rate on cash, and that's going to be cell B11, and let me lock down B11 as well. All right, so imagine this number will change as well because the cash for 2005 right now is 0. It will be changed. All right, so the profits before tax. So look at this formula here. I can actually copy this across. I can actually calculate the profits before tax, even though these numbers will be updated. All right, so again, I focus on the right formula. All right, so now can I look at tax here? Well, I have the good formula. I used absolute cell reference, so I can copy this across. I can actually look at what's the tax, for 2005, and let's just look at this one here. That's a robust formula. That's also a robust formula, and this one too. So I'm going to select these three cells and copy across. Okay. So these are the income statement for the moment. All right, the numbers will change because certain numbers will be updated after we solve the model. All right. Now let's actually proceed to the balance sheet. Okay, we're done with the income statement for the moment, and we're going to update the numbers after we finish solving the model. All right. Now the income statement, the balance sheet. The first item here is cash. All right, we said cash is the plug. What does it mean? All right, so listen up. Cash is the plug. Remember, we could, maybe I can actually make a simple analogy here. All right, so when you are building a financial planning model, it is like, you're building a very sophisticated evaluation machine. All right, so, after the machine is fully assembled, you want to make sure, you can actually insert the key, and maybe you're building a car. All right, you want to insert the key and start the engine, and the car is running. Okay, so that's going to be your last step. All right, so that's the so-called plug. So here, when I actually use cash as the plug, this means I'm going to actually leave cash to the last step. All right, and if I actually insert the key, into the end, I'm going to start the engine, and the machine is going to be running. Okay, so I'm going to save cash for the last stop, for the last step. All right, that means I'm going to move on to current assets here. All right, so current assets, according to our assumption, that is 15% of sales. Whoops, I should say, just to be consistent. Let me take sales and let me multiply that by the 15%. All right, so that's current, assets, and let me lock down current assets here as well. Okay, and the fixed assets at cost. All right, so now what should you do? So this is the total fixed assets, and if you don't know what to do, can I actually move on to total depreciation? All right, so total depreciation, well, that's going to be what you have depreciated as of last year plus what you are going to depreciate over this year. Okay, so some people might be confused by what I said. So let me give you another simple analogy here. Let's say at the end of last year you had $100 $100 savings, and this year you saved another 200. So how much savings do you have today? Well, so you have $100 savings last year, and you saved another 200. So your total saving today is going to be 200 plus the 100. That's 300. Okay. So similar logic. All right. I'm going to look at the total depreciation here. So that's going to be the total depreciation as of 2004 plus the depreciation for 2005. All right. What's the depreciation for 2005? Well, we have this number here. So that's the depreciation, that's the annual depreciation, okay? So that's going to be my total depreciation. And you guys can actually, follow me here if you want, all right? And the net fixed assets, that's going to be, well, according to our assumption, net fixed assets is 77% of sales. So let me take sales for 2005, and let me multiply this by 77%, okay? And of course, I want to actually, lock down the 77%. All right. So I don't know what's the total, what's the fixed assets at cost, but I do know the two components, the total depreciation and the net fixed assets based on the assumption. All right. So now I'm going to actually, add up these two things, and you watch me closely, and I'm going to show you what happens here if I press enter. All right, so this is the right formula. I'm just adding up the total, depreciation and net fixed assets to get my fixed assets at cost. Earlier, when we actually have the depreciation number, for 2005, that depreciation is 10% depreciation rate times the average fixed assets at cost. So there was no number here in this particular cell, and now I'm putting this number back. And if I press enter, Excel is actually going to finish one round of iteration. Excel is going to update the numbers about depreciation. So, I have not pressed the enter yet. So the depreciation for 2005 is 535,000. And now I press enter, and yes, the number has just been updated. Excel has just finished one round of iterative calculation. All right. So that is, apparently, something, very subtle, but I have, just, shown you how you can actually, appreciate the power of iterative calculation in Excel. All right. So now I have to get my total assets. But remember, we actually saved, total cash as the plug. So I don't have a number for cash yet, which means I cannot calculate my total assets. All right, so that's okay. We can actually skip this for a moment. Let's move on to the liability and shareholders' equity side. All right, so current liability here, well, that's going to be, if you look at the assumption, current liability, that's 8% of sales. So let me take the sales and let me multiply this by 8%. All right, so I want to lock down the 8% here as well. So that is, the current liability as we assume. All right, and now we can look at debt. All right, the company has $3.2 million debt, and we are actually saying, all right, this is now using the financial policy assumption. All right, so we're saying the company is going to retire $800,000 debt per year for the next 4 years. So if I want, I can actually say, all right, you have $3.2 million debt, and you want to actually reduce or retire $800,000 debt. All right, so you're going to have $2.4 million debt, as of 2005. And actually, if I want, I can actually, this is retired another 800,000, another, and you're going to be, all right. So they want to, by 2008. All right. So the company is going to actually pay off all the debt, and then the company plans to stay debt free. So by 2009, the company is actually going to have zero debt. Okay. And let me just make sure, yes, that's what we should be doing. All right. And let's look at, stock. So the company has no new share issuance. The company has no share buybacks. So yes, I can actually copy this across for the next 5 years. All right. So now I can actually look at my, and by the way, I just, fill in the number for debt, and you should realize that the debt, interest, is updated as well. Okay. In other words, this number has already gone through another iterative calculation. All right. So now I'm going to look at the total accumulated retained earnings. So this is what you have as of last year, and this is what you have retained, for 2005. So that's going to be the total accumulated retained earnings for 2005. All right, so now I can actually add up the total liability plus shareholders' equity. Okay, so that is $10.75 million. All right, so we are done with the liability plus shareholders' equity side for the moment. But there's one final thing for us to do, which is the cash being the plug. So remember, we saved the cash for the last step. Now, let me further explain why you actually want to save cash as the plug. Remember, you're actually building this valuation machine, and you're making all these assumptions about current assets, current liabilities, net fixed assets, debt, stock, and so on and so forth. So it is possible that, these assumptions are internally inconsistent. All right, so you may ask me, what do you mean by internal inconsistency? Well, basically this means if you do not do anything about these assumptions, then your balance sheet may not be balanced. In other words, your total assets may not be equal to your total liability plus equity. Okay, so if that's the case, we are screwed. All right, we want to avoid that. So one way for us to avoid that is very simple. We're just going to actually look at, total liability plus equity, and we're going to manually set total, assets equal to total liability plus equity. How about that? All right, so I manually balance the balance sheet. Okay, by construction, my total assets will always be equal to total liability plus equity. And now I can actually save cash as my plug. I can actually solve my plug because I have the total assets and I have the current, I have the net fixed assets and I have the current assets. So this is our final step. This is like inverting the key and starting the engine. All right. So watch me closely. If I press enter, the numbers will change. All right. So, for example, the interest on cash, that number should change because you're going to actually fill in cash for 2005. So the interest earned on cash is going to change and everything should be, back up and running. All right. So let me press enter here. And indeed, all the numbers, they have changed. Okay. So we have just solved this financial planning model for year 2005. All right. So let me just verify everything looks good. So now I can actually forecast this into the next 4 years as well. Some of you may wonder, can I do this for the next 5 or next 4 or 6? Well, yes, but you would have to exercise a little judgment here. You have to determine when you're going to stop, because you can't say, I'm going to forecast the financial statements for the next 100 years. That's totally BS. Okay, so, that's just too far away. All right. And I'm going to actually copy this across here. And, you see a bunch of numbers, a bunch of zeros there. Don't worry, they're going to be updated. And I'm going to actually copy this across as well. And the numbers are, updating again. And I'm going to copy this as well. And the numbers are not making any sense because certain numbers are missing. And so I'm going to copy this across. Okay, so everything is now back up and running. All right. So we have just finished solving this financial planning model. Okay, going back to our map. We are done with step number 3. All right, we just forecasted the financial statements for the next few, for the next 5 years in this example. All right, and I want to show you one thing before I continue further. If I want to actually stop, the iterative calculation, or if you have not enabled the iterative calculation, then you're going to see our error message. And I want to show you the error message so that next time when you see this, you can actually, you can actually, fix the problem. All right. So if I go to formula, if I uncheck this box here, and I just somehow forgot to enable the iterative calculation, and then Excel says there are 1 or more circular references. Okay, that's a problem. If you click OK, Excel is actually telling you where that is. All right, so there's a formula here in cell C19. There's a formula here in cell C32, and the formula here in cell C33. And you're actually using iterative, you're actually using circular references. And because you do not allow Excel to apply iterative calculation, so Excel is lost. Excel doesn't know what to do. All right. So you see this, blue line here emphasizing you are having, circular cell references. All right. So let's get back and let's kill the circular references here by enabling the iterative calculation. All right. Click OK, and it's gone. All right. So we're all good. All right. So the next step is we're going to actually, calculate the free cash flows, because our final destination is actually going to, value the firm. All right. So here I'm going to continue to work on step, 4 and 5. All right. So I'm going to actually look at free cash flow, calculation. Okay. As we're saying, we're finance people. we are actually building our own financial, statement of cash flows. All right, we're focusing on the free cash flows. Okay, so I'm going to build a year here as well. This is 2004. All right, and I'm going to copy this across. Okay, I just want to bring this back, so that it's easier for you to actually keep track. Okay, and I want to actually, get all the components for the free cash flows. All right, so you can actually go back to equity valuation chapter and look up the definition, but you don't have to, because in the in the lecture note we have, right? Let me refer to the page number here. In page 5, you actually have the cash flow, free cash flow component. Right? If you want, you can actually copy and paste this definition here. And this is direct from the lecture note, excuse me. All right, so I'm going to go ahead and calculate all these components and calculate the free cash flows eventually. All right, so first item is profits after tax. Okay, profit after tax. All right, so for 2005. All right, I'm going to start from 2005 because 2004 numbers, they affect the valuation in 2003. So if you're trying to value the firm, at the end of 2004, you look forward. All right, so profits, after tax. Well, I don't mean to put this in bold. Oops, I can just unbold this, and that should be good. All right, so profits after tax. That should be equal to this number here. This is for 2005, all right? Profits after tax, and I can copy this across. And I'm going to look at the next item here, depreciation, okay? Annual depreciation, all right? So remember, we're trying to calculate the after-tax cash flows. Now, in the capital budgeting chapter, we discussed the two approaches. One is, you take out depreciation earlier and then you put depreciation back. Okay, that's what we're doing here. The other way is you forget depreciation, you just do earnings, and then you pay tax, and then you put back the tax benefit of depreciation. All right, these two approaches are equivalent, but we're doing the first approach, which is taking out depreciation and putting back depreciation. So we have to put back the depreciation here now. All right, so we're looking at annual depreciation. So that's actually in the cell C19. All right, so that's the depreciation for 2005. Okay, we're looking at the income statement. All right, and then we have increase in current assets. Okay. If you look at this definition here, increase in current assets. So I'm going to look at the current assets for 2005. All right, and I'm going to subtract the current assets for 2004. So this way I get the increase. All right, that's actually 150,000, and I can copy this across. And I can also look at increase in current liabilities. All right, so that's going to be the current liabilities for 2005 minus current liabilities for 2004, and that's 80,000, and I can copy this across as well. All right, be very careful, you're dealing with a lot of numbers here. All right, and then look at the definition here, increase in fixed assets at cost. So I'll say increase in fixed assets cost. All right, so we're going to look at fixed assets at cost for 2005. I'm going to subtract the fixed asset at cost for 2005. We're going to actually follow the definition here, and then we're going to look at after-tax interest payment. So you have to actually add back the after-tax interest cost on debt. All right, so after-tax interest on debt. Right, so we have to do this on the after-tax basis. So what we are doing here is we have to take the 1 minus the tax rate, and we have to multiply this by the interest payment on debt. All right, so interest payment on debt, that is this number here, and this is multiplied by 1 minus the tax rate, which is 40% we assumed. All right, and certainly we want to lock down the 40%. Okay, so that is the after-tax interest, cost on debt. All right, and I can copy this across. You get some zeros here for 2009. That's not a surprise because the company has no debt at that time. All right, and then you have after-tax, interest, cash. Okay, so you're looking at the interest you earned on cash. All right, and you're doing, on the after-tax basis. So 1 minus the tax rate here again. So the tax rate is 40%. So I'm going to lock down the 40% here, and that's going to be this number here. And then now I can actually copy this across. So I'm almost ready for my free cash flows per period. Okay, free cash flows to the firm in this case. All right, so I'm going to do the calculations now, and I can actually, follow this definition here if you want. So this is now equal to, all right, so let's look at the definition. Profits after tax, okay, plus depreciation. We're putting back depreciation, and then we're doing minus increase in current assets, okay, minus increase in current assets, plus increase in current liabilities. All right, so this actually corresponds to the increase in net working capital. This is now reconciling with, the cash, free cash flow definition, equity valuation. All right, and then you have to do, capex minus depreciation. All right, so you would do minus, increase in fixed assets cost. All right, and then you do, plus, after-tax interest on debt, and then you do minus after-tax interest on, cash. All right, so that will get you the free cash flow for year 2005, and I can copy this across, and I just calculate the free cash flow for all the other years. All right, so looking at our map here, we finished the first part of step 4, which is calculate the free cash flows to the firm, and now we have to finish the valuation exercise. How do we value this firm? All right, so here we have the free cash flow growth rate. We have the free cash flow to the firm per year. And what about the future years? So this is where we have to make 2 additional important assumptions. All right, so these are fairly important. So first of all, what is the weighted average cost of capital? So we're looking at the free cash flow to the firm. So yes, we're looking at, the WACC as the discount rate. If you're looking at the free cash flow to the firm's equity holders, you're looking at cost of equity. So let me just assume a 14% weighted average cost of capital here. This is assumed. Apparently, this is a very important assumption here, all right? And then we're going to look at, well, the long-term, free cash flow to the firm growth rate, okay? So we want to say, yes, the firm can have all kinds of, free cash flows, in the next few years, but eventually, if we want to actually solve this model and value this firm, we want to be able to have a stabilized free cash flow growth rate. And let's just say this is 6%. All right, I should say starting from year 2010. Okay, because we have modeled, we have calculated the free cash flows for 2009 and before that. All right, so if that's the case, I can now bring back my calendar timeline here, and this is 2004, and this is 2005, and I'm trying to value the firm, so this is where we have an infinite horizon here. Okay, of course, we're going to find a way to cut it. All right, and then we can actually have my period timeline back because I need them for discounting. All right, so this is 1 period from today. I can actually copy this across. So 2013, that corresponds to period 9. And then we're going to look at free cash flow, to the firm. So we just copy down the number here. That's for 2005. And I can copy this across. All right, so that's for 2009. And now you say, all right, you have the free cash flow to the firm growth rate. And it's actually stabilizing at 6% here. All right, so I'm going to lock down the 6%, and I'm going to copy this across. Okay, that's the long run free cash flow growth rate stabilized at 6% starting from 2010. So apparently, I can look at the free cash flow in 2010, which is the free cash flow for 2005, for 2009, multiplied by 1 plus the free cash flow growth rate. Okay, so I can copy this across, just like what we did for the dividend discounted model. All right, you have starting dividend, you have the dividend growth rate. Yes, you can calculate all the future dividends. All right, so now the question is, how do we actually cut this into a finite timeline? Because this is annoying. This is making this thing, not operational. All right, so we're going to apply the Gordon model, and we're going to calculate some kind of a terminal value here. All right, if you are a little rusty, please go back to equity valuation, chapter. All right, this is why we have to discuss the equity valuation first before we actually move on to financial planning model. So the terminal value here, that's going to be, you look at the free cash flow growth rate, it stabilizes at 6%. So you can calculate the terminal value here in 2010. Actually, the earliest one you can calculate is actually for 2009, because starting from 2010, the free cash flow growth rate actually stabilized. All right, so I want to be consistent with what I did for equity valuation. So I'm going to calculate the terminal value in 2010 by dividing the free cash flow in 2011 by R, which is the 14% discount rate. I want to mark these down, minus G, which is the 6% free cash flow growth rate. All right, so that's actually the terminal value for 2010. So now my timeline is finite. We are considering a short-term investor who is actually going to hold the firm for only 6 periods. And let's look at what is flowing into this short-term investor's pocket. All right, so this is the terminal value. This is like the face value. This is like the resale price plus the last period free cash flow. So the free cash flows, they are like the coupons, they are like the dividends. All right, and I can copy this to the left. And now I can actually say present value of each cash flow. All right, so I'm doing the discounting here again. So we're back to essentially chapter 2. All right, we're actually valuing our multiple cash flow structure here. So this is discounted at 14% discount rate. I want to lock down this, raised to the power of 1. So this is the present value of the first cash flow, and I can copy this to the right. I get the present value of the other cash flows, and this is actually present value of all cash flows now. All right, so that's going to be the summation of all these present values, and so that is this 225 something. Okay. And remember, this is actually the enterprise value. All right, so this is also going back to equity valuation discussion. All right, and you can actually replicate this number by doing the MPV function if you want. All right, so now we can actually look at market value of equity. All right, so market value for equity. Remember, this is actually from the definition for enterprise value. All right, market value for equity is equal to the enterprise value minus debt. So what's the debt? Well, we have to look up and find the debt here. That's a 3.2 million plus cash. All right, and the cash is actually this 800,000. All right, so that's going to be the market value for equity. And let's assume number of shares outstanding, all right, is let's say 1 million. All right, so if that's the case, you can actually say share price. All right, so this is nothing but the aggregate market value of equity over number of shares outstanding. So you get $20.11. That's the share price. Okay. So we're done with step number 4. We calculate the free cash flow, and if we finish the valuation, for the free cash flow. All right. So step number 5, sensitivity analysis. So here I'm going to use the data table to examine the sensitivity of the share price to the 2 inputs. All right, so the 2 key inputs are WACC and long run, free cash flow to the firm growth rate. Okay, so this is a little review now. So we have done data table in chapter 3, capital budgeting. So now I'm going to actually finish the data table here. I just want to look at what is a reasonable range for the the weighted average cost of the capital. So I'm going to set up everything in a row. And I'm going to go, as low as 10%, and I'm going to go by 2% increment each time. All right, this is only for illustration. All right, in the real world, 2% increase, that might be, too large. Okay, so I'm going to go all the way to 26%. All right, this is again for illustration. So, in the real world, you would have to justify why you think the WACC could be as low as 10 or as high as 26. That's a very large interval. All right, and I'm going to look at the long run free cash flow on the growth rate, in this column, and I can set up 0 as the lowest, and I can increase this by 1% each time, and I can actually go as high as, let's say, 6%. Okay, so these are the different combinations of the weighted average cost of capital and the long run free cash flow growth rate, and we just want to actually populate these cells with the corresponding share price for each of the combinations. And so what we need to do is to make sure that you have the 2 input cells here, and there's a link between your input and your output. So let me just change this 14 to 15. All right, yes, the number changed. Okay, that's good. So let me get back to 14. And let's change this to 5%. And number changed as well. So yes, there's a link between these 2 inputs and the output. So now I can actually go to the top left corner and put the share price here. And now I can actually select everything. If you don't know what I'm doing here, go back to the capital budgeting chapter and look up the notes I have for doing the data table. All right, so go to data, what if, data table. All right, so the row input cell is going to be, we set up the WACC in the row, but when we calculate this output, what is our input? Our input is this cell here. All right, the 14% in B55. And our column input cell is actually, the column input is actually the long run free cash flow growth rate. And when we calculate this output, the input we use is the 6% long-term free cash flow growth rate. Okay, and let's click OK. And Excel should populate all the numbers here, and it did. All right, so the best share price is actually on the bottom left corner. The lowest share price is actually on the top right corner. This is when the WACC is the highest, when the long run free cash flow growth rate is the lowest. So you see that in the illustration we have here, there is actually a substantial difference between the lowest and the highest stock price. All right, so if you want to play with other data table with smaller increments, you may still see a lot of variation in your best and worst stock prices. Okay, and we just finished everything we laid out, and I'll stop the video here. All right.